Blockchain tokenization is changing the way financial assets like bonds and funds are traded by turning them into digital tokens that can move quickly and cheaper than traditional methods. Now, this could open investing to more people and improve market liquidity, but currently these tokenized assets live across different systems, public blockchains, private networks, and old traditional financials. Now, infrastructure is complex, and each connection can create technical problems or data errors and even governance issues. Joining me to weigh in this morning is Todd Kanaster, Director at S&P Global Ratings in the Americas. So good morning and thank you so much for joining me. So first, explain to us, how important is clear regulation and common rules for making tokenized assets safe and easy to use?
Great. Thank you for having me. It's a pleasure to be here. So we see a transformation happening in decentralized finance, or DeFi, right now as tokenization scales up. There are different users right now on different blockchains for various reasons, and we can see financial efficiencies being gained in that due in part to the secure interoperability among these varied chains. So now our eye going forward is on consistent standards and oversight. This could reduce blockchain isolation with regards to liquidity.
And Todd, for the layperson out there who's not familiar with interoperability, can you break this down for us and explain which technologies or bridges are best positioned to connect these blockchains and legacy systems?
Sure. So yes, developments have come across different jurisdictions as well as financial systems. Public blockchains, permission networks, and traditional financial infrastructure all operate somewhat independently. So secure interoperability between them will play a critical role accelerating the adoption of tokenized assets and addressing fragmented liquidity. So now, what types of interoperability are we seeing? So three examples that come to mind: atomic swaps, liquidity pools, and bridges. Now, just kind of at a very high level, an atomic swap is a decentralized peer-to-peer exchange across blockchains. So what that means is it's a time-locked contract that creates essentially an escrow for all parties. And if all parties are satisfied, then the transaction continues. If any party is not satisfied that the transaction is meeting its obligations, then the entire thing is canceled. That's the atomic nature and helps mitigate some counterparty risk. Now, being peer-to-peer, these atomic swaps may be used to get around the know your customer laws, and that could lead to a little bit of risk there. Liquidity pools, this essentially, if you have a token and you wanted to earn some yield on that, you can put it into a liquidity pool. And so then if I wanted to purchase that token, there's an algorithm that would determine the exchange rate as well as the fee that I pay you to purchase your tokens. Being algorithmically driven, of course, that leads to some programming risk that we have our eyes on. Bridges, multiple types, different risk pictures, and these are generally costlier and less efficient, though we expect this to mitigate and reduce over time through use and refinement.
And of course, we can't have a conversation about this without talking about the regulatory landscape, and regulation as well as industry standards are critical, especially in financial services. So what do you think is the path to greater adoption here?
So, yeah, we expect the risk that we discussed here to somewhat abate through increasing regulatory clarity, like as you mentioned here. And over time, growing consensus around standardized protocols and clear oversight frameworks, these will help reduce risks. And we expect this will happen as participation in decentralized finance, or DeFi, continues to grow and become more widespread.
And of course, there are a lot of opportunities, but also risks. And connecting different blockchain as well as traditional systems can create technical as well as management challenges. So, given some of these risks, how can they actually be managed before they spread through the market?
Sure. So we mentioned adding interoperability protocols certainly supports scalability and help reach more participants easily, but you're connecting blockchain to blockchain. So you're creating a new point of risk now. Um, do you need to preserve accurate information between the blockchains? Make sure that there's no delay in moving information back and forth. Also, this new point, this new intersection, creates a new point of threat for cyber attacks. And so We need to keep our eye on all these new risks coming from interoperability in order to gain those benefits.
Well, Todd, we will have to leave it there for today, but thank you so much for joining us and thank you so much for sharing all of your insights.
Thank you.